Australian jobs could well hinge on global events, and all eyes are on Europe. Yesterday, markets were relieved at the German Constitutional Court's ruling that supported Germany's European bailout. But what now? Well, the prominent investment banker and advisor Ken Courtis has just flown back from Europe, and he joins me now from Beijing. Ken, welcome to the programme.
Thank you, Tiki.
Well, it seems to me that in the last couple of weeks there's been almost a tipping point in everybody's views. A lot more Cassandras out, now talking about a fairly imminent financial crisis. What has changed?
Well, we're sort of in a crab walk to disaster, Tiki. You've got complete disarray in Europe. You've got the central bank fighting with various governments. You've got different governments asking for different things. In the last few days, the Central Bank of Europe, the European Union and the IMF were in Greece negotiating. They left with no agreement. And as we look at things tonight, just imagine that one-year interest rates for Greece are over 80%. Two-year rates are over 50%, so the market's saying this thing is going to bust.
Italy, I understand, has a big rollover as well, due by the end of this month.
Italy has the biggest rollover at the end of this month that Europe has ever seen, and that's going to really tax investors and the ECB if they're going to have to stand in front of this vast rollover. Plus, they have another $250 billion to raise by the end of the year. So these next few months, Tiki, are going to be extraordinarily challenging for Europe.
Big focus on the banks now, of course. Just how are the most exposed of the top banks in Europe?
Tiki, this is fundamentally, you're right, a banking crisis rather than a government finance crisis. Because if the governments can't pay back the debts, then you have banks that will fall over like 10 pins. Some of these major European banks have exposure to just government debt in these countries to 3, 4, 5 times their equity, some 7, 8, some 9, 10 times their equity. So even a small failure would knock these banks completely on their back, and we could have a Lehman situation emerge if Europe can't come together quickly on this.
I see the chief of your old shop, Deutsche Bank, is saying exactly that it could be a lot worse than 2008.
Well, that's right, because this is a crisis of a much bigger dimension. And Tiki, the problem is that no one can hide, because the banks globally are so intertwined. If one of the big ones goes down, we get in trouble everywhere. America, Europe, all around the world.
Now, I see today the OECD has put its growth rates out. Germany's annualised growth of 2.6% in the third quarter is going to contract by 1.4% in the last quarter of 2011. Now, if you were Germany, is the default option for Greece the better one, as opposed to continuing to bail out the ECB or the European Stability Fund?
Well, the cost of a bailout will be monumental. You'll have big banks that'll go under. You'll have, of course, the entire Greek financial system, which would collapse. It's so costly that I think they're even afraid to envisage it, which is unfortunate because they really only have two choices. That is, allow Greece to default and leave the euro, or put $1.5 trillion to 2 trillion euros on the table to handle the troubles in Ireland, Portugal, Spain, Italy and Greece. And I don't think Europe has come to terms with the dimension yet of the problem.
Do you think this is what Christine Lagarde at the IMF is lobbying for as well?
Absolutely. I think she gave a very important speech 10 days ago saying that the European banks had to make it a top priority to raise new capital. I think that she wanted to go beyond that in the speech. I've heard rumors that she wanted to include the U.S. banks, which are also lightly capitalized in many cases, but apparently the White House and others in the U.S. administration didn't like that sentence, and she dropped it from the speech, apparently.
There's obviously a big crossover between the European and the American banking systems. Now, what do you make of Obama later this evening, our time? What is he going to be able to do in terms of pulling America back from its own recession?
Well, I think the American recession is one that's going to last a long time, because America is carrying debt to GDP at the same levels as many of these European countries are. and you just can't continue with that much debt. And so they're going to have a period here where a lot of debt doesn't get paid back, austerity. The U.S. economy today is zero growth, zero jobs, and zero interest rates. And there's not a lot that Obama can do on the fiscal side. Plus, he's completely blocked on the political side. So I hope he gives a good speech. I hope it creates some optimism and there's some imagination in the speech. But I think expectations aren't very high.
Ken Courtis, thank you very, very much for joining us. It'll be interesting to see what impact all this will have on China too. But thanks for that.